through Chapter 7, and that's the second part of our non-refundable credits. Okay. And as we can see on the chapter there, it says non-refundable credits part 2. So remember, non-refundable are those credits that can eat up our tax bill. So it says both non-refundable and refundable credits provide a dollar-for-dollar reduction in the total tax due. Okay? But we cannot go negative. We cannot go below 0 on the tax due. If we're going to have anything that is a refund over and above, comes in the payment section, either as withholding or those refundable credits. All right? We are going to do some, our objectives here is to talk about the retirement savings contribution credit, the child tax credit, residential energy credit, which expired at the end of 16, so we'll kind of look at it. I don't know if that'll come back. It's hard to say. The adoption credit, credit for elderly or disabled. We won't spend much time on that. We'll spend even less time on the alternative motor vehicle credit and the plug-in electric drive motor vehicle credit. Never going to do it. It's kind of in there for information. Okay. We'll take a look at these credits on here. All right. As it shows there on 7.4, it kind of talks about where all these credits are. When you look at the tax return, we're talking about page 2 of the 1040. And we're in here in that section that says, you know, within tax-wise says non-refundable credits. You see all those credits in there, the ones we've been talking about, okay? So those are all with there in different lines and different forms. All right. Retirement savings contributions credit. And Mark, what's that better known as?
Savers credit.
The Savers credit. You always hear Esther talking about the Savers credit on the radio show. The retirement savings contribution tax credit is a non-refundable credit available to lower income taxpayers who make contributions to an IRA, either traditional or Roth, or employer sponsored retirement plans. Okay? The credit is available in addition to any deduction available for an IRA contribution. We'll come back to that again, that IRA contribution, when we talk about adjustments to income. Maximum credit is $1,000. The retirement savings contributions tax credit can be claimed on, it shows all the different forms there, and the form 8880. I think we had the one problem that it lit up on the tree on the left, because as soon as we put that D in box 12 on somebody's W-2, and it adjusted their income within that W-2, then it showed up right there on that 8880. Okay? The eligible contributions, contributions to a traditional Roth, as we said, 401k, 403b, 457b, SEPs and Simples. Volunteer contributions to qualified retirement plans, that's defined in section 4947C. That includes TSPs, and contributions to a 501c 18D. So basically, the Savers credit, putting those in there. Okay. As far as the credit, here's where we talk about the credit as far as who is the retirement savings contribution credit is not available if either of the following apply. The retirement savings contribution credit is not available if either of the following applies. So you can see if AGI is more than a certain amount. So when we're looking at that $30,750 for single or $46,000 head of household, 61 married filing joint, it's kind of a helper for somebody that really is almost biting the bullet probably, and it's, you know, paycheck to paycheck, but they're really funding the retirement. It's kind of the government saying thank you for not relying on Social Security. Okay? All right. The person who made the qualified contribution or elected deferral was born after January 1st, 1999, is claimed as a dependent on someone else's return, or was a student. Okay? And you notice when we do all of the problems in the workbook, what's one of the bullet points? It's always in the workbook, we always have that one that says neither one of the parents was a full-time student. And what shows up on the form 8880 is one of the first questions. So if we're doing that retirement savings contribution, we're doing that 8880. Okay. What we just talked about. So I got the 8880 up here and the caution. We just went through all those income things. We just talked about the persons. And what's the last questions? Was the taxpayer or the spouse a full-time student? So if that 8880 lights up for them, when we go to that form on our tree on the left, we're going to have those questions that light up red. As soon as we put in yes, what's going to happen? They're going to lose that. Okay. It shows the form on 7-7. All right. And what is the other thing that tends to happen within that form?
Phased out.
Yeah. Phase out. Yep, the greater the income. And what about if you're taking distributions?
Certain distributions received after 2013 and before the due date of 2016. So directly include both spouses' amounts in both columns.
Yeah, so there's some things that end up that, you know, you can't contribute and take the credit and then turn around and take the money out to use it for something else. So they want it to be, because what is it called, Mark?
Save.
So it means you're saving, not recycling, I guess would be a word. Okay, you're not rotating it through the different funds. All right. All right, 7-8, we have the child tax credit. The child tax credit is a non-refundable credit available to a taxpayer with a qualifying child. Obviously, we have our words qualifying again. It's that test. And it's also hammering home all of our qualifying child tests. All right, we have that with the EIC as a dependent, filing status. You know, that qualifying child, that's where a lot of those things, you know, have to do with, you know, the different credits or things that we would be eligible for or filing status. We're always circling back to that qualifying child. It's where, as soon as there's a child on the return, there's a lot of things that are triggered, especially EIC. Okay. All right. It is possible that a taxpayer won't be able to claim the full $1,000 or any of it in the case of no tax due. In that case, the refundable additional child tax credit may be available as a method to claim the remaining. We've seen that in a couple problems, depending on the income, if they end up eating up all their tax bill and they don't need the entire $1,000. All right. But do remember that that $1,000 is all you need to raise your child for a year. Okay. Everybody should be able to budget themselves to raise a child for $1,000. Okay.
This one isn't, I know that married filing separately doesn't come into play. A lot of the other credits, if they're married filing separately, you can't take. But this one,
yeah.
I don't see married filing separately as a.
Chances are, what happens in a married filing separate? What do we bring into play? There's two households.
Right.
So because the married filing separate, you know, somebody may be releasing the claim for the child as an exemption, and that credit will follow the child. Okay, so I think that's why they leave the credit in play, because they're trying to benefit the child.
Yeah, okay.
So
That makes sense.
I know the IRS can be cold and unfeeling, but sometimes they
This
do.
is one is the benefit of the child.
Exactly. You know, that's the way I look at it when you're doing married filing separate and you get into the whole tie-breaking rules of who gets to claim and who gets head of household and all that other stuff considered unmarried. There's a lot of things in play. Then the EIC comes into play and stuff like that. But a lot of times with them releasing that through that 8332, you know, that's one of the things they're trying to probably help a higher taxpayer in the equation between the two separate households. So, all right. We have our 7 tests of a qualifying child must meet for the purpose of the child tax credit. So we have all those. What's the big one that always comes into play? What's that?
Age.
Yeah. Some people don't realize that once they turn 17. Now, do you remember what I told you about New York State?
Yeah, you get this dead zone.
Yeah, well, you get dead zone, but New York State, at what age does the child tax credit kick in?
Kick in.
You don't get it the year they're born. The year that they turn 4.
Is that an empire?
Yeah, the Empire Child Tax Credit.
That one, okay.
Yeah, because I think the rationale is because it's refundable. You get it no matter what. It's totally refundable on the state side. That until you turn 4, it does not kick in. Okay? All right.
What does 6 mean? Does not file a joint return? You were just talking about that.
Oh, the child.
Yeah, but how would a child file a joint
So
return?
they were married when they were 16.
They gotta be underage, they'll be married at 16.
Mm-hmm. I don't do many of those.
Okay.
Virginia, you do. Tennessee.
Hey, be nice. My wife is from that part of the country, so be careful. Tread lightly, Patrick. All right? Okay? And she is also a 20-year veteran and a marksman from 300 yards. So.
Oh. But if you marry your brother, do you still call him a brother or are you?
Well, it depends if they're a U.S. citizen. All right. Child tax credit. Up at the top of 7-9, it talks about adopted child. Okay? An adopted child is always treated as the taxpayer's own child. An adopted child includes a child lawfully placed with the taxpayer for legal adoption. The taxpayer is a U.S. citizen or a U.S. national, and their adopted child lived with them all year as a member of the household in 2016. The child meets condition 7 above to qualify for the child tax credit. Okay? All right. What about foster children?
Yes.
Yeah, you get paid to have a foster child, so how would you get the credit
Well, you can get the credit.
for the child?
Mm-hmm. Yep. Well, when we get into itemized, I'll show you that there's with some things with foster kids. You know, obviously most people get a stipend from the state to cover expenses, but you know, if you have expenses over and above, you can actually use those on your charitable, because you're able to take things that you do. You know, say that you got a stipend, but one of your foster kids has to have handicap accessible to the house or something like that. And obviously the stipend that you're probably getting from the state's not covering it. You know, that modification to the house, you can deduct as a charitable on there. Okay, but we'll talk about that when we get to itemized. So there's a lot of other things that we do. Okay. There's an income phase out. A lot of people don't realize this. The married filing joint's at $110,000 for the AGI. It's always funny when you get a household that finally breaks that income and you look at them and say, I'm sorry, but your kids aren't worth the credit on the return anymore. And they kind of look at you like, but they're still eating and still, you know, it's just one of those. So as we'll talk later, that's where sometimes I'll inform them and go, well, the adoption credit actually is a much better credit than the child tax credit. So if you'd like to adopt, but you know, that means that down the road, then there's more expenses.
If you, let's say you marry somebody that has 3 kids, you adopt them. Does that affect you or not?
No.
Now you after married. Right?
Yeah,
Once
if you're doing married filing joint. So, all right. Okay. So that's that with the income. All right. Claiming the credits. We do it on the form, and then there's, again, the 8812 with the additional child tax credit. Okay. Little flow chart on 7-10. All right. This one, Mark has some little numbers for footnotes, so just in case for reference there. Okay.
No excuse.
Because on that one, you know, was your dependent physically present in the United States on at least 31 days during 2016? And there's a little footnote down there. It says, see days in presence in the United States in Pub 519 for days that do not count as days of presence in the United States. Okay. What's that probably referring to?
But when they come from overseas?
Yeah, but I, you know, think. Yeah, but somebody that's stationed overseas with children. because, you know, if they're stationed overseas on a military base, it probably has something in there to do with, you know, in the United States, because that is a territory. So if you got a family that's stationed in Japan with the military, so maybe a case in there, okay? Let's see, on 7-11, it kind of goes through a little bit more about a child who's lawful permanent resident of the United States is eligible to obtain a Social Security number. That is a W-7, an ITIN. A lot of times what happens with kids, especially foster kids or adopted kids, depending on how smooth the adoption went, you know, they may not come with a Social Security number or have one right away. I have one client that took forever because the dad that was incarcerated did not want to release the Social Security number because he was holding out hope that he would be able to still claim the kids. Why? He's incarcerated, had no income. I don't know what he was planning to do with those kids and their Social Security numbers. But, you know, sometimes you have to go through that and try to get an ITIN for them with those on there. Okay. All right. Okay. Some child tax credit worksheets that are on there. Again, they're just kind of there to show you how that form works and see the calculation. Talks about the phase out. You see 713, you know, with the amounts that are there. It shows so that you can see if you can disclaim any of the kids based on your income and the phase out and other income sources. Page 715, it shows that the child tax credit shows up on line 52. And again, the amount that would show up on 52 was only going to be, you know, in this case, they had how much of a tax bill? $68.76. So they were able to take all 4 kiddos. If that tax bill had only been $38.76, then you would have seen a portion of it go where? Yep.
Additional child tax credit.
Yep, down on line 67. So it's not like it's lost unless it's part of a phase out. All right. Okay. All right. Page 721, resident energy credits. Okay. Again, this is a credit that supposedly has gone by the wayside. But it has 9 lives, I swear. It's several years in the past. It is, but all of a sudden there's all these things passed at the end of the year and it coattails onto something. The only thing I can think of is somebody that has a state where there's a big employer for Carrier, you know, making air conditioners or furnaces, or somebody has a Windows, or somebody's making wind turbines. I mean, you know, somebody says, wait a second, you're hurting the constituents because people are not going to do things to their homes that would help my business that makes air conditioners or heaters or windows or whatever. So it keeps it keeps coming back. Like I said, it has 9 lives and just keeps coming back. However, in recent time, it's come back. It's pretty minimal. Okay. I don't know if anybody remembers, you know, 5, 6, 7 years ago, every advertisement you saw on TV for people that replace furnaces, you know, get your furnace replaced, you get $1,500 on your taxes, you know, because they really showed the money because it was a pretty sizable credit. All right. That $1,500 now is $150. So it's shrunk to that for a furnace. So, you know,
Where do you file for that?
What's that?
Where do you file for the furnace?
That's what we're going to talk about.
Oh.
Okay. What I'm, you know, and so a lot of it's shrunk down to what it is. That's where now you just see the ads where somebody says, oh, if you get a new furnace, you get a federal tax credit. Well, they don't say how much it is because, you know, a $4,000 furnace is going to get you $150. Okay. So we see on here that the residential energy property credit, that's form 5695. So you'll take a look at it. It has, I'll bring it up here so we can talk about it. It's in that non-refundable portion. All right. So we have some stuff that things about qualified solar electric property cost, solar energy, small wind, and geothermal. Actually, one of the guys that worked with me at Lockport had a maritime person that he did geothermal. So I guess if you have a lot of spare time and you want to dig a really, really deep hole, you can heat your house that way. And they're very sizable credits because it's not cheap. But you're not going to get your money back. And I forget how long on some of these it takes to recoup with your electrical savings what you spent and what's net after the credits. But there's credits both on the federal and the state. Okay. Solar, same thing. I guess the only thing about these is that there are very good credits, but they're not cheap to put in. And the solar, the time that it takes you to recoup it, you know, with what you, and yeah, I hear people that do the solar that have $5 electric bills every month. But how long at $5 a month is it going to take you to recoup? And also, it's kind of an odd credit because the government's in both sides of the equation. They're giving you this huge credit to the consumer, but what are they doing with the solar energy industry, all the companies? Yeah, so you got the government holding up both sides of the equation. They're in the production side and they're in the consumer side. So
New York State was paying a lot for Solar City.
Mm-hmm. Yes.
So that Solar City's had some financial trouble.
Yeah. So, and you just wonder, how long can you support both sides of the equation before you say, okay, it's self-sustaining, you pull out one side or the other, what's going to happen?
Did you see in Florida that when we had that last hurricane, if you have solar energy, you are not allowed to use it to run the electrical stuff because it's a contract with the National Grid or whatever in Florida.
Mm-hmm.
Because the lobbyists prevented you from using it if the system was down.
Yeah.
So where did you find 5695?
Page 2 of the 1040.
Yeah. What is it in other credits?
No, non-refundable credits, because we're in chapter non-refundable credits. So if you go to 1040 page 2 and you look in the non-refundable section 48 through 56, 53 residential energy credits. Okay, and then when you have 9 in there, it takes you to 5695. Okay, so you know the big part on that first page, most of the time what you're going to use for folks is page 2, where it starts to talk about energy improvements to their house. Talks about qualified energy improvements. The big one is exterior doors that meet or exceed version 6.0 Energy Star program requirements. Okay. Again, when you hear the word Energy Star, that little sticker when you're in the consumer, you see that, used to be a big deal because what would you get? Oh, I bought an Energy Star refrigerator, because that was, some of them were that way and some weren't. You had that little sticker that says the cost to run this appliance was X number of dollars. You used to get a credit. When you walk into Lowe's or Home Depot now and you look at all the appliances, is there any of them that don't have the Energy Star on it? I imagine they can't produce it without. Okay, so those talks about metal or asphalt roof that meet or exceeds Energy Star program requirements. When we're looking at that, anybody know what grade of asphalt roof might meet this? That architectural grade? Yeah.
We use that.
Yeah.
The difference in price is not that bad. So.
No, in the architectural, but a lot of it, you know, that's where you see a lot of people doing these metal roofs. And, you know, again, the credit's not that great on them. They are capital improvement, so they may not be, you know, if you do the certificates, you may not have the state sales tax. But, you know, as far as the credit, you know, when you start looking at the maximum, they back things off. Exterior windows and skylights that meet or exceed 6.0 Energy Star programs. Again, you know, we're talking about exterior doors, exterior windows, okay? Just because you put an extra thick door on your bedroom so it wouldn't be cold at night doesn't meet, you know, an energy with the interior. It has to be exterior, okay? All right, down at the bottom, it talks about, on the same form here, it talks about energy efficient, qualified natural gas, propane, or oil furnace or hot water boiler. Do not enter more than $150, okay? For those of you that have replaced your natural gas furnace or hot water boiler, were you able to do it for $150? I know. And that's why I say this credit has really shrunk to very minimal. It is a credit. It's $150. You know, and $150 is $150. What's the other thing that is in here that they talk about with the energy credit? The amount. Exactly. If you look at page 7-22, it says, however, this credit is limited as follows. The total combined credit limit of $500 for all tax years after 2005. 500 lifetime limit. All right. So a lot of people were used to the old rules, you know, that they were able to do their windows one year and then the furnace and then the roof, and they got these wonderful credits, but it's limited to 500. So if they got the 500 for doing windows and a furnace in one year, they come back to me and says, you know, we did all the doors and now we did this.
So it's all either way, so you can't just strategize.
No, and again, there's not a lot that you can do to get it to, you know.
This is gone, so for 2017.
Well, right now it's not on the books, but again, like I said, this thing's had 9 lives every year.
I was curious, so, because in our house, we actually just did replace our sliding patio door.
Mm-hmm.
And that was after the old one was as old as the house, was 47 years old.
Yeah.
We just did replace it. Start reading this paper, going, gee, I wonder if we can get the credit.
If it meets the Energy Star and meets the criteria.
It has to meet the criteria. I know it's Anderson.
Yeah. And I would imagine so. There's a lot of people because, you know, sliding doors are a huge heat loss. If you don't have a seal.
It wasn't cheap. I mean,
yeah.
Doors are expensive.
Yeah. And you notice that for the houses that they think they're going to be replacing, they never have the door that matches the side of the older houses. The doors are all off. You know,
right.
It's like they were thinking, saying, okay, so now we're going to change the size of all the doors that won't fit all the houses that need to replace them.
Our door had to be custom because of the size. It required a custom order. And
Yep.
It was just a little bit taller than their standard size door.
Same thing you see with all the ads for windows, $99 windows. Yeah, I've never found an opening in my house that fit the $99 windows. So, but, all right, adoption credit. Okay, so we have the adoption credit. How many guys are thoroughly confused on the adoption credit?
Yeah, that was a mess.
Yep, yeah. There's a lot to it. It's you know, you can see that it is a great credit, but there's a lot of back and forth into prior years. You know, the year that the adoption takes place, you can take the credit for expenses in the year prior. There's a lot of things that happen with it. So starting on 7/25, all right, we have it there that the tax benefits for adoption of an eligible child include both a refundable tax credit and an income exclusion for employer-provided adoption benefits. These tax benefits offset qualified adoption expenses during the adoption process. Has anybody here adopted? No, it's a long process. You know, like I've said earlier with the one family that I had that took so long because dad just, you know, who was incarcerated was the only parent they had, just wouldn't release anything. So, you know, mom, I guess, was in a foreign country and they couldn't find her. So they didn't know where she was at. Okay. The adoption credit is up to $13,460 per child. All right. The credit is non-refundable, which means it is limited to reducing that year's tax liability. However, any excess credit may be carried forward for 5 years. I think Chris did it, a lady from the city that was a foster parent and ended up adopting some of the kids, and you know, was just a great lady for this. First time she came to Chris Fabian at the corporate office, he says, well, why haven't you been taking the credit? And she goes, I didn't know there was a credit. But her income was such that the credit going back on some things that he could do, plus carrying forward with the extra credit, you know, it was tens of thousands of dollars over the span that he did for this lady, which for somebody that's doing adoption and taking these kids in and giving them a home, huge benefit. So you really have to understand, like I said, the back and forth, all right, that goes on with those. All right. On the top of 726, there's our favorite word, qualified, okay? Qualified adoption expenses for both the credit and the exclusion. That talks about defining them. Our qualified adoption expenses include adoption fees, attorney fees, court cost, traveling expenses, including meals and lodging while away from home, and readoption expenses relating to an adoption of a foreign child. Anybody know what that means? It's my
Adoption expenses relating to the adoption.
yeah. My understanding is, you know, and again, I'm going kind of with my explanation when I ask somebody that does a lot of this through a church. Some countries, when you adopt a child, you go to that, you know, it talks about traveling. You may adopt that child in that country. Yeah, but it's not a recognized adoption in the States, so you have to readopt them. So it's almost like you have to do it twice. So a lot of times the adoption may not be recognized by the United States. So once you bring that child and you want to adopt them, you're readopting, I guess, for lack of a better term. Okay. Qualified expenses do not include funds that were received under any state, local, or federal program that violate state and federal law. I guess this kind of goes back to what we talked about illegal activities for other income. If you're on the black market buying your adoption, yeah, it's not deductible. Okay. Carrying out surrogate parenting arrangements.
So you can't take the expenses you do to the surrogate mother and all the medical expenses. That's not deductible.
That surrogate mother?
You'd be better off adopting her, deducting her, and then getting rid of it.
I'd have to do the math on that one. There's a lot of variables, I think, in that one. For the adoption of a spouse's child, who asked earlier? Somebody asked earlier about, about a family getting married and adopting the kids, okay? Think about that one. I mean, with the number of families that, you know, sometimes, you know, do you think the credit would still be $13,000? I don't think so.
But I guess by being married and you've got the kids in the house, could you claim as dependent anyway?
Yeah, now they're dependent because you married them. Yeah, you're not adopting them. So reimbursed by employer or otherwise, or allowed as a credit or deduction under any other provision of federal income tax law. Okay. So basically what it's saying in there is that, you know, anything that you pay for the adoption of this child without, you know, doing it illegally, or you're reimbursed, you know, those are the things that you can claim for this $13,460 carry forward eligible in the year prior to the adoption on everything that's there. Okay. Now, the next few pages have a bunch of different stuff that talks about different examples. When you're reading these, you're kind of, you know, you're trying to figure out what's the flow. I'm going to use the forms here. So, because sometimes it's a little easier to look at the form and see where the, all right, as far as finding the adoption form, it is on line 54. Okay, so if I go to line 54 on my 1040 page 2, hit F9, I can see in there my form 8839 is in there. Okay. All right, so this is not going to fit on the screen. Okay. So we can see on our form 8839, it talks about information for our eligible child. Child's name, year of birth, was it born before 1999? Now, the thing that comes in here a lot when we hear about these is the disabled or the special needs, okay? Does anybody remember from the reading what special needs falls under, the categories for special needs? It's a lot broader than you think.
It's whatever state defines the special.
Exactly. So a lot of times, this is another one. Whenever I do an adoption, I want to see the paperwork from this case, it's Erie County a lot of times, or Dyer County. New York tends to be the county agencies, because on there, that will define them. It can be because of their race or ethnic origin. It can be because of their twins or siblings or of their age. There's a lot of things, but that, just as you said, there's a designation that comes in when that person is classified as a special needs, okay? Has under here the child's identifying number, okay? And then it talks about, did it become final in 2016 or earlier? Why is that question on there? Because we know the credit can be what?
Carry forward.
Yeah, carry forward or taken in the year prior for before the adoption is finalized. Okay. All right. A little farther down, we have the adoption credit. And again, when you're reading and you're looking at these problems, some of the ones they have examples here, we'll kind of go through some of those. But we can kind of talk about it, but the form is very good. All right. As soon as I have a child in there, so let me get a child inside the form here. Who am I doing? Joe and Sally Brown. We're going to say we have okay. All right. So I put a child in there. As soon as I put the child in there, what happened to my maximum credit? It showed up for me, didn't it? So as soon as I had all of my criteria up here, okay, I did put in that Emily's special needs. All right. Okay. So we start looking at credit. I have my credit. So I'm kind of starting with that, aren't I? Because what's going to happen with some of my calculations, I may not get the credit because what may be the first one? My employer has a program that they'll give me $5,000 toward an adoption. Okay. Second question says, did you file Form 8839 for prior year for the same child? Okay. We're going to say no in this instance. All right. So we have our credit. Now we're on qualified adoption expenses. Okay. Your qualified adoption expenses may not be equal to the adoption expenses you paid in 2016. See instructions. So what we just read there on page 726, where it talked about qualified versus non-qualified, what might we do? It's kind of almost similar to what we see with the education credit. We paid this amount, but we got this amount from the state. So what were actual qualified out-of-pocket expenses? Okay, and anymore, there's not a lot of extras unless you're adopting, a special needs child. The city may give you, or the state, or county, or whatever may give you some money towards the adoption or cover the adoption expenses. But adoption's not cheap. Probably why this credit is the way it is. Okay. So we're going to say that we're going to say $10,000 worth of adoption credits, or excuse me, out of pocket expenses. Okay. All right. Now, as we go down to the bottom, all right, we had Joe and Emily have $25,650 of adjusted gross income. So we can see the credit here, but what happens to the adoption credit? It is what type of credit? Okay. So what happened with it? How much of that money were we able to use? Okay. What happened to the rest of it? Carried forward to 617. So it's not like it's lost, right, but it can keep carrying forward. So when you look at this, you can see our previous 5 years, right, and that's why I said the instance for Chris is when he went back and did this lady's and amended some stuff.
Well, how far do you go back? Just the 3 years, or you can go back a lot more?
Well, the thing is if you amend going back, if I do somebody's return with the statute of limitations, I can only start to use those carry forwards in the years where I have an eligible window. Which is 3 years. Yeah. So, it still ended up being a lot of money.
Tim, so things like that,
mm-hmm,
and the loss carry forward, does tax-wise keep those things stored for when you do future returns? Or do you
yes, the net operating losses and stuff like that would carry forward. Yes. Okay. That's why whenever I start with somebody, I will ask to see a couple years, because there's sometimes things that I don't have because tax-wise is carrying forward that I have to make sure I enter in.
So is there a place to put the carry forwards for a new client?
Well, yeah, you'd probably want to do them within here. Because if somebody comes in with a return from 2014 and they need to do 15 and 16.
So those things are green that you could put.
They're not.
They're yellow.
They're yellow, but you could do them on a scratch pad and make a note on it that you put that in there to carry forward with the calculation.
If you don't have, if these people are going to different places, the only thing you have is a tax return. say. To see if they made those claims.
Yep.
But the other thing is they may have those expenses that they didn't claim because Liberty or whatever didn't know anything about it.
Or didn't do it correctly?
Didn't
Yes.
do it correctly. So even if you went back 2 or 3 years on a tax return, you'd have to be asking a lot of questions.
Yeah, yeah. You know, and that's where sometimes when you see the return and, you know, if you see a different last name or you see kids that are born within months of each other on birth dates, you know, those things are kind of red flags that say, okay, we got 2 kids that were born 3 months apart. Is this from 2 families, you know, married together, or is there an adoption in place here? All right. So, you know, you start to, but yeah, you know, you just got to figure out to ask those questions on the adoption credit. Okay. All right. It talks about a lot of the other things with the adoption credit and the limitations and things like that. Just make sure you understand what those are. You know, it's more so with the form that you know you're starting with a credit. You're identifying that child from that beginning. And we're saying, okay, what did I receive? And then what am I carrying forward? And knowing that it's non-refundable. Making sure this calculation, because obviously somebody that's done an adoption, you know, they want to take the credit or have access to the credit. Well, you know, we got to keep carrying it forward. Okay. All right. Okay. All right, page 730, we get into a little bit about filing status. If the taxpayer filed their return using the married filing separately filing status in the year particular qualified adoption expenses are first allowed, they cannot claim the credit or exclusion for those particular expenses. So what's that telling us?
Married filing separate solution.
Yes. Not probably a good, married filing separate's not a good addition, is not a good tax situation for adoption. But I guess just looking on the surface, I would have trouble thinking that an adoption would go into a married filing separate situation. I guess, you know, if they're evaluating it, so.
Well, what if this, you know, I hate to say it, but what if 2 gay guys adopted this kid? That would definitely be married filing separate.
Not necessarily.
Not necessarily.
Is that affect?
Because back on, let's see here.
Well, they're both working, they're both making, well, I guess it depends.
Qualified adoption expenses include expenses paid by a registered domestic partner who lives in a state that allows a same-sex second parent or co-parent to adopt his or her partner's child that otherwise qualify for the credit. Registered domestic partners are not considered married for state purposes and therefore not considered married for federal purposes. Okay, so
they
basically,
can't do it.
well, but it depends on the state.
So it is a,
Yeah, but it's not a federal, so, I mean, they can do it on the state in New York. But you're saying they can't do it on the federal?
But the thing is that registered domestic partners are not considered married for state purposes and therefore not considered married. Does New York State allow domestic partners?
Yes.
So can they take the credit?
Sounds like yes.
Yes.
Because then they can do married filing.
Yes, because they can do married filing joint. So, and I don't know that there's any states anymore that don't allow domestic partner unions. I think it's pretty much gone across the state. So,
Just curious, did this, say they were married filing jointly when they initially took the credit, but they had to carry forward because it's a non-refundable credit. In the following year, they become married filing separately. Chance that would impact the amount they're able to carry forward, or would they not be able to carry
they'd
forward?
lose it.
They'd lose it.
Keeps them together.
Yeah.
Well, in a sense of it, keeps them together. You would hope that that would be more beneficial to the child.
Right.
So, all right. Review of the adoption credit. There's a great little review there starting on 7:30, kind of summarizes everything that we have on here, okay? If the taxpayer adopted or tried to adopt a child in 2016, they may qualify for a tax credit. If the employer helped pay for the cost of adoption, the taxpayer may be able to exclude some of their income from tax, okay? If you look over, there's a
What
little...
page are you looking on there?
730. If you look on the bottom of 731, okay, we have a W-2 that shows T in box 12. What is T?
Taxpayer.
No, the code for T in box.
Code T for.
Gee, I wonder
this is W-2.
Mhm. Box T is adoption benefits. So if you go to 3-13 in your textbook, there's a little table for box 12. So if you want to write down there by your little W-2 and that thing, please refer to page 3-13. T is adoption benefits, okay? So if we look at that and we look up at the boxes 1, 3, and 5, what do we see? Obviously somebody makes a lot of money.
Yeah.
But what happens with the difference between 5 and 1? We're able to lower our taxable income.
Why did Social Security go so low?
Because of the cap, the maximum, 6.2.
Oh, that's right.
So, yep. Yeah, as soon as you see that 118 number, you know that they've made a lot of money, okay? Maximum benefit talks about it being $13,460. There's a carryover. The eligible child, an eligible child is under age 18. This rule does not apply to persons who are physically or mentally unable to care for themselves. Qualified expenses, it talks about those that must be directly related to the adoption of the child and be reasonable and necessary. This is probably the first time that we've come into this words. We'll hear it again. Reasonable and necessary. The IRS loves this. Qualified and reasonable and necessary. Okay? Domestic or foreign adoptions. Most cases, the credit can be claimed whether the adoption is domestic or foreign. However, the timing rules for which expenses to include differ between the two types of adoptions. What's that probably meaning? That's that what we talked about earlier, that readopting, depending on the situation. I think there's a lot of that the readopting that comes, my understanding is from South America, because you can adopt a child down there, but then you bring the child back and you have to readopt, depending on the country. Okay.
You do that before you can bring them in? Well, I don't understand. How would you pass them?
Well, you can bring them in.
You can't bring them?
Yeah, because you're bringing them in, but you have to be in the adoption process. Because, you can take it, in essence, what you're doing is timing-wise, you're taking the adoption expenses now in the year prior to when it may be finalized, because the court system just ain't going to move that fast in states. Special needs, we talked about that. No double benefit. Depending on the adoption's cost, it may be possible to claim both the tax credit and the exclusion. However, the taxpayer can't claim both a credit and exclusion for the same expenses. All right? What's that say? Can I take that $10,000 that they took off my taxable income? That would be double dipping, wouldn't it? Okay? Income limits. The credit and exclusion are subject to income limitations. And record keeping. Records must be kept documenting any qualified adoption expenses. This is especially true for foreign adoptions where expenses are often paid in cash. Okay? So I guess that means that going to adopt a foreign baby, they don't usually accept MasterCard, Visa, or American Express. Okay? If you're in a country where you're paying cash, you're going to have to make sure you keep track of things. Okay? All right. And going back to Patrick's comment, that cash paid on the black market does not qualify. Okay? Even if you get a receipt, you cannot do anything that qualifies on that. Okay? All right. Plenty of worksheets for the child tax credit and the exercises at the end there. Okay. Page 756. All right. We have credit for elderly or disabled. Okay, this credit for the elderly or disabled is a non-refundable credit available to taxpayers who are either age 65 or older at the end of 16 or retired on permanent disability and have taxable disability income. The credit is limited to the tax due, and they must meet certain requirements for this. Okay, they have to be a qualifying individual. All right, so it talks about what that is. They were age 65 or older. They were under age 65 at the end of 2016, but they're retired on permanent and total disability. They received taxable disability income in 2016. Okay, chances are somebody's on Social Security disability and that's all they're on. Are they going to have any taxable income? No. Okay. All right, permanent and totally disabled. As it says there, a qualified physician must certify that the condition has lasted or can be expected to last continuously for 12 months or more, or that the condition may be expected to result in death. Okay? Yeah. Okay? All right. You just don't see a lot of this. If you go over to page 758, to determine if the taxpayer can claim the credit, 2 income limits must be considered. The first limit is the amount of AGI. The second limit is the amount of non-taxable Social Security and other non-taxable pensions, annuities, or disability income. If the AGI and non-taxable pensions, annuities, or disability income are less than the income limits, the taxable may be eligible for the credit. Okay? So if I have a single person, their AGI on the tax return is $17,500, or the total of your non-taxable Social Security and other non-taxable pensions, annuities, or disability income is equal to or more than $5,000, I can do this. Single person, $17,500. That's over 65. That's poverty. I mean, that you got to consider poverty is what, 11,700 now? I mean, we're talking about not a lot of money. Okay. The other thing, if they're in there and they're in that level, in that wheelhouse, are they having any money taken out? No. And do they have really any taxable income after we take into account their exemption and their itemized? So you're looking at a pretty narrow window on this one. Yeah. You know, even for a couple, married filing joint, your adjusted gross income is equal to or more than 20,000. Okay. You can't take the credit if your adjusted gross income is more than 20,000. Well, if you got a couple living on less than $20,000, wow. I hope there's more than this credit helping them out. Okay. They probably have chickens. They may. So, okay. All right. Like I said, just understand more so that you understand the income limits, because you can tell that you're not going to run across this a lot. Because when you have somebody at that income level, chances are they're not filing. And then the second part is total of your non-taxable Social Security or other non-taxable pensions, annuities, or disability income is equal to or more than 5,000. You can't take this. What would be those? What would be examples of those things that I just listed or just said? Non-taxable Social Security or non-taxable pension. Well, but on the federal level, that's still going to be taxable. What would be a non-taxable pension?
Taxable.
The pension doesn't show up on tax returns.
Federal employee?
No, federal employee could show up there. That's still 1099-R. Military disability.
Disability is
Yeah.
not taxable.
It never even shows up on the return.
Huh.
Okay, so if you think about military pensions, if they're out on a disability discharge or whatever, they're out on military disability pension, they never even touches the return. So, and you still see a little bit of that because we still have some of the World War II generation, or now we're starting to see them with people that would be Vietnam or Desert Storm. All right. As I said, alternative,
And
yes,
that's federal or state?
for the,
And state, for the military.
most of that just comes federal. There's really never any state on that.
But if you live in New York, aren't you obligated?
But my wife was a New York National Guard. She can't receive disability until she's 65 for the state. If she was a full-time military or a federal reservist, she could be drawing her disability right now.
When my father died in Australia, my mother got his military pension.
Mhm.
Disability pension, whatever she would be.
Yep.
Well, it must be the same thing.
All right. As I talked about, alternative motor vehicle credit. Just read it. Okay, it's one of those ones that, again, in the plug-in electric drive motor vehicle credit, I've never done one. Nobody's ever brought it up. And again, it's one of those industries, it's kind of like the solar, the government's subsidizing both sides.
The interesting thing about that one, if you were a Toyota dealership and you leased a Prius out, you get the full deduction of the dealership. The person leasing it doesn't.
Yeah. Yeah.
Right.
Yeah, it's one of those little ones that's kind of loopholes on it. Okay. All right, so that's chapter 7. Like I said, the big ones that we talked about when we're adding in the stuff from chapter 7, we were doing the savers credit, the child tax credit, the energy credit. Again, this is kind of for our sake for 16 when we're doing these practice returns. We don't know if it's going to be around for 17. The adoption credits. Again, that one little summary page is great because there's a lot of pages on the adoption credit, but knowing how the form works, starting with that $13,460, knowing what's excluded, what qualifies, defining special needs, that's really what you need to know from that. That great little page that has those bold little bullets in a page and a half really is all that needed to be in there instead of all the other pages, okay? And then the elderly and disabled is the other one, but again, like I said, when you look at those numbers, I can't believe it would be anybody that's even filing anyway.
Well, why do you hear so many people saying, they get together, but they're not going to get married because it's not what they want? Older people, because of the tax situation. I don't see how that affects.
Well, it depends on,
So they would live together, married, filing. Well, they wouldn't be married, filing.
they used to file single. Because a lot of times what happens with those is depending on their pension and their Social Security and how the numbers work together. Separate, none of their Social Security is taxable, but if you put their 2 pensions together, it may make some of their Social Security taxable. So that's typically why you would see that situation.
So in other words, a lot of times, when you get to that age, you might as well get divorced.
But depending on how the divorce went, if you're part of the divorce, one or the other may end up with half the pension as a quadro. So you got to be careful there. Okay.
And you do it amicably.
That ranks right up there with jumbo shrimp. Amicable divorce and jumbo shrimp are kind of the same, All right. Okay. So problem 7.3. So we're going to start a new return. We got the little information here for Jimmy Randall. So we have his social. Okay. So we have Jimmy M. Randall, and we have his wife, Susan. Well, it says last year they did a 1040. Okay, so we have Randall. All right. 468-44-8795. Okay. We have their address living on 78 Oak Street. And we have an email is jimmy@verizon.net. Some phone numbers for them. starting to do these main info sheets in your sleep?
Yeah.
While you're doing them, it's just a great time to talk with the client. So, you know, that you're asking them questions about things that you might see or things that come up about anything or whatever it may be. So it's just an ideal time to start to talk to them. Okay. Computer programmer. And as we've talked about a little bit, a lot of this stuff carries forward. Sometimes you're just going through and checking it to make sure it's accurate from the information they might have filled out in the waiting room or anything like that. So they're doing married filing joint. We got two, excuse me, we got two kiddos. We got Nicholas Randall. Oops, got ahead of myself. He was born 8/12/2002. We got a social security number. It is a son that lived with them all year long. Okay. All right. Looks like we had some dependent care expenses for them. All right. And we have Tammy Randall. His daughter who lived with them. And remember, like I said, always use that check that earned income credit box. Okay. They're going to be e-filing. We have bank information for them. And as I said, you know, the state ID stuff will make more sense when we do get into the returns in the office. Okay.
But mine says select your bank.
Just to,
Use one of those.
no, that's we'll do more of that when we talk about bank products when we're training in the office.
Okay.
That's where we were talking earlier about the fast cash and all those different ones. That's where that when that comes into play. Okay. All right. So if I take a look at my bullet points, let's kind of go through those. Jim and Susan filed a 1040 last year. Okay. Or excuse me, 1040A. So what's that mean?
No.
So that little box in the middle of 1040 page 1, we got a no. They would like to deposit in their checking account. If they owe taxes, they would like to mail a check. We need to finish their 216 return. Here's that little statement that we were talking about from the Savers Credit. Neither Jimmy nor Susan was a full-time student in 2016, nor did they receive any distributions from any retirement plans in the past 3 years. Remember our 8880? You know, those little things that happen in there. No EIC was disallowed or reduced. Tammy was adopted by the Randall family in 2016. They incurred $10,800 in adoption expenses. They paid dependent care for their children, and they had health insurance all year long. So we're going to get rid of the health insurance here. Check those boxes off. Okay. First thing we're going to put in is that we have a W-2 for Jimmy from Continental Computers. So we'll put his W-2 in there. The addresses match. We have his employee ID number.
What if you saw a bunch of stuff in and you get one of these exams? It's gonna be-
I don't set any time limits on the exams. You'll be all right. Within reason.
That exam. Is it open book?
It is always open book. Unless I decide that you guys really should be trying to do it without a book.
We can do no state ID, driver's license, just to get rid of that one.
Yeah. Yep.
So
Okay.
I know we have these physical books. Do you have an ebook,
What's that?
like a book in PDF for like something you can put on the, and this be put on the stick?
Yeah, you want me to?
Oh, yeah. I
Yeah,
like that.
yeah.
I seem to be able to search faster.
I'll make sure I have it. I don't think I have my thumb drive with me. It has it all on there.
Oh, yeah.
But on Friday, I'll make sure I have it, and then I can just download it to your thumb drive so you got everything electronic.
Thanks.
Nothing in box 12 or 14. All right. And again, on the New York, sometimes out of sight, out of mind, make sure you go to the bottom. I have a gentleman that's in my night class that's one of his things, and I was that way too. I was cruising along and I forget bottom of the W-2, bottom of the form on the computers. When I was first doing it, that was one of the things I had to really train myself to remember to go look for it, because it just kind of it's not there. So, all right. All right, so we have that for Jimmy. We also have a W-2 for Susan. So we're going to put hers in there also. She works at Office Equipment Incorporated. Russian Avenue. I wonder if she's part of the whole federal investigation. All right. Okay. Again, nothing in box 12 or 14 for them. You know, that's where, you know, on one of these with the adoption, we might see something from an employer that would be listed in box 12 with a T if they had a program for that. And we have state withholding. Okay. All right. Next thing we have on page 99 is what? We have Humpty Dumpty Nursery. Okay. And when we go to our 2441, we're just, we're a little limited on space. So we're just gonna have to shorten it to Humpty Dumpty. All right. That is on 234 Union Road. Okay. And we do have an EIN number, so we check the box. And they paid a total of,
460.
yep. And how much did they pay for each of them?
1230.15.
Okay. All right. So we have that. And then the last thing we had, what was one of our bullet points? We had Tammy was adopted by the Randall family. All right. That form, nothing that we did on the main info when we checked anything is going to show up anything particular. So we know that we're going to have to go to our 1040 page 2. We know we have it.
Now, the Humpty Dumpty Nursery, just quickly, what form was that?
If
2441.
Yep, if on your main info sheet, after the kids, you check DC for dependent care. On the left,
On the
main info sheet, so where you put the kids in, if that column, you know, the one where the EIC and the CTC are,
yeah, that's on. Yeah, I got that. Where do you,
then on the tree on the left, is there a 2441 that has red?
what did I go back?
Yeah, go back up to your main info there.
DC care, dependent care. Yeah. Okay. And then the form should pop up over here to see the 2441. But yep.
Okay. All right. And then if we go to line 54 for non-refundable credits, and we hit F9, we know there's a whole bunch of stuff in there, a lot of things that we've talked about. But the one that we're looking for is the 8839 for our adoption expenses. Again, one of those forms, kind of like our education credit, it does not automatically populate because there's nothing that we've set on the main info sheet that has anything on this. So we're going to put Tammy in there, and last name is Randall. She was born in 2005. Oops. 2030, how am I doing? 2005, okay. All right. And we're not classifying her as anything on special needs, but we do have to put her social in there. Okay. And as it says in there, the adoption was finalized in 2016. All right. We did not file anything for her in any prior years. And we had $10,800 of adoption expenses. Okay. It does mark red on here if the check if this is the first and only form text for this return. Obviously, if you got somebody with adopting more than 3 kids, it would be a feet and a half, I guess, to start with, but you would have to do another additional form on there. Okay. And we can see that we took a credit, we ate up the tax bill, but some of this is going to be carrying forward. Okay. All right. Okay. Any questions on anything? Okay. All right. Any questions? As far as the answers, I came up with a refund of $97.22 federal and a state refund of $14.73.
What if I type something?
That's where, again, I talked a little bit.
When you go to the credit for child dependent care, and it comes down to qualifying versus name, and then they ask you to put in the qualified expenses. Where do you get those from?
The bullet point. Read on page 97. There's a bullet point about the adoption.
Oh, just the 10,800?
Yes.
So you just put it in for the one child, right?
Yes, just the one child. Just Tammy is the adoption.